Hello and welcome to this session. This is Professor Farhat, in which we will discuss three concepts, which are other comprehensive income, and accumulated other comprehensive income. They are interrelated, obviously. They all include something to do with comprehensive income, other comprehensive income, and accumulated other comprehensive income. So the topic is simply comprehensive income. So I'm going to take you from A to Z. Why do we have comprehensive income? What is comprehensive income? On which financial statement does it go? What's the benefit of it? Why do we use it? So on and so forth. But the first thing we're going to do is to look at prior financial statements that we are familiar with, such as the income statement. So what goes on the income statement? On the income statement, we have sales, cost of goods sold. Sales minus cost of goods sold gives us gross profit. Here we have less sales returns and allowances. Then we have a bunch of operating expenses. Then if we take gross profit minus our operating expenses, we get to operating income. And usually that's an important number for business decision, how much your business is making from operating the business. Then we have non-operating section. Under non-operating section, we could have other revenues and gains, interest, gain on sale of assets, other expenses, interest expense, loss on sale, total non-operating revenue / gains and expenses. We net them out. Income before taxes, income tax, income from continuing operation. We might have discontinued operation and they are reported net of tax, and we talked about this topic separately. Then we have net income. Now, why am I going over this income statement if the topic is comprehensive income? There's a reason why I am doing so. The reason I'm doing so is to show you that there's a lot of things, a lot of revenues, expenses, gains, and losses that are listed on the income statement. That's great. So if revenues, expenses, gains, and losses are listed in the income statement, so what else is income then? Well, guess what? We're going to learn about items today that they are not unusual. Not every company might have, well, let's call them unusual. Unusual in the sense that not every company will have them. They're specialized in nature. They're not reoccurring. You only have them under certain circumstances. And those items, don't worry about them. We're going to define them shortly. They do affect your net asset. They increase your equity. But we don't want them to appear on the income statement. So there are items that affect your equity, because remember what happened to net income. Net income goes to retained earnings. Retained earnings is part of equity. So everything that you see on the income statement eventually ends up in retained earnings on the equity section. Simply put, everything that you saw on the income statement ends up on the balance sheet as retained earnings. Guess what? Today we're going to be learning about items that you don't see on the income statement. However, they do affect equity. And guess what? They do affect equity, and eventually, and you're going to see this later, I'm going to show you the slide later, they eventually end up on the equity section of the balance sheet under a new section called accumulated other comprehensive income. So this is where this old CI, OCI ends up in accumulated other comprehensive income. Simply put, there are items that are part of the equity. They increase your equity or they decrease your equity. Actually, it's other comprehensive income / loss. Sometimes you might have a loss, but they don't hit the income statement. Hold on a second. Well, income statement include revenues, expenses, gains, and losses. Well, there are other things other than those that we're going to see that we are familiar with that don't belong there. And this is what comprehensive income is, OCI and accumulated other comprehensive income. I know this is just a big picture. Let's go and start to define each item step by step. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
starting with comprehensive income. So what is comprehensive income? So let's define this word, comprehensive income. Comprehensive income represent the total change in a company's equity and net asset are the same over a period that arises from business activities and events that are not linked to the company's owners. What are the company's owners? Well, the owners, they contribute money to the business, which is capital or common stock. They contribute money, they get common stock, and they take money out of the business in form of dividend. So anything else other than contributing capital and paying out dividend is comprehensive income. What are we talking about then? It includes all equity changes within that time frame except for those directly related to owner investment and distribution to owner. Owner investments are common stock, what the owner contribute to the business, and distribution to owners are dividend. So this is what comprehensive income is. So simply put, comprehensive income is net income. What does net income include? I just showed you. Profit or loss of the company after expenses, taxes, costs have been subtracted from total revenue. This typically found on the income statement. So net income, it encompasses revenues minus expenses plus gains minus losses. This is net income. Net income plus other comprehensive income. Now here we go. So what is other comprehensive income? So we're gonna include net income and comprehensive income. So part of comprehensive income is net income. So comprehensive income, CI, let me go back here, CI, when we get to CI, we're gonna start with net income plus or minus, let's put it plus because we're gonna call it comprehensive income, but this could be a loss, OCI plus OCI equal to CI, equal to comprehensive income. Now, what's included in other comprehensive income? Let's start to define comprehensive income. That is income or loss for that matter, but let's keep it with income. That's not included in net income. It involves gains and losses that have not yet been realized. So we have certain gains and losses that they have not been realized, but we don't want them to hit the income statement. They might include, for example, we're going to see a list of them, unrealized gains on security or foreign currency, foreign exchange adjustment. So other comprehensive income is a list of things that we don't want those things, those gains and losses. You remember we have here gains and losses that are on the income statement. We don't want those gains and losses on the income statement. Now, why? We're going to find out what these items are and why we don't want them. So the first thing we're going to have to figure out is other comprehensive income, because if you know what other comprehensive income is, we know what comprehensive income. It's net income plus or minus other comprehensive income. So what is other comprehensive income? So once again, other comprehensive income consists of revenues, expenses, gain and losses that are part of comprehensive income but not included in net income. So there are certain items that are gains and losses that increase or decrease our net asset, but they're not part of net income. What are they? Let's start to list them first. Pension adjustments. If you have a pension, you might have to do certain adjustments. We're going to look at those separately. Unrealized gain and losses on available for sale securities. Foreign currency related issues. We're going to see them. Liability-specific credit risk. We're going to see that. So those are items that anything that's related to those items, any gains / losses, unrealized specifically, unrealized, and we're going to define unrealized soon. Unrealized means you have not sold them yet. They went up in value, they went down in value. We want to reflect that change in the increase or decrease in value, but we don't want them to hit net income. So we want to list them after net income. Therefore, what we do is we list them, let me just go back here, we list them here after net income. So we don't want them to hit net income yet. Why? Because they have not been realized. We did not sell them and there's a change in value. So we have to show them, but we don't want to show them under that. Starting with pension adjustments. What are pension adjustments? If a company has a pension plan, what's a pension plan? A pension plan is a retirement plan for their employees. So when their employee retires, when they retire, they stop working for the company will owe them money. So the company will have to put away money now so they have enough money to pay those employees. Now, if the company has the money, that's fine. If they don't have the money, they will have a liability because they owe this money. So they will either have a pension asset if they have enough money, or they will have a pension liability if they are short on their pension. Now, when you are accounting for a pension, you might have gains and losses. So in operation of pension plans, gains and losses can occur due to several factors such as changes in actuarial assumptions like life expectancy, wage growth, differences in actual and expected return on plan asset, and amendment to plan benefit. Now the good news on the CPA exam, that topic is no longer tested, but simply put, you still have to know what pension adjustments are. Pension adjustments are adjustments to gain and losses. Like what? Let's assume the actuary, the person that estimate this liability, it tells us how much we're going to owe. Let's assume this year they told us estimate 10 million. Great. So the company says we need to have 10 million. Well, because life expectancy means people are living longer, means your retirees, the people that retired from your company, lives longer, and what's going to happen as a result, you're going to have to owe not 10, you're going to have to owe 12 million. So guess what? Your liability went up. Well, guess what? You have a loss in a sense that you have an additional expense. An additional expense of 2 million. Now what's going to happen is this, you're going to have to make an adjustment. But we don't want the 2 million because it's an increase in your obligation to hit the income statement yet. Why? Because that's a large increase suddenly because of life expectancy. So what's going to happen is we are going to put this 2 million in quote loss in other comprehensive income for now. So these gains and losses, and I showed you losses, are not recognized immediately because usually for a pension it losses. It's net income because they can vary widely from year to year, potentially distorting the company's financial result. Because those changes are large, we don't want them to hit the income statement. So what do? We let them hit the OCI first. Don't worry, I'm going to give you a journal entry. Just use your imagination. So under US GAAP, these gains and losses are initially recorded in OCI rather than directly affecting income. So the accounting allows the company to smooth out the impact of those pension plan volatility over time. And that's why, because if this 2 million hit the income statement, well, the company might incur a large loss because of the pension, and we don't want that. So the gains and the losses held in OCI are not permanently sidestepped from affecting the financial statement. Eventually, they are amortized, they are released over time in net income. So this increase in 2 million, this increase, because it's a loss, it's an expense, eventually, let's assume we're going to amortize it, put it in income to make it easy over 20 years. So what's 2 million over 20 years? It means we are going to expense $100,000 per year over the next 20 years. This is what we're going to do. And this is an example of when we initially book the loss. Suppose a company experienced an actuarial loss, again, because somebody told the actuary, the person that estimated their liability, told them you have to increase your liability by $50,000. This loss indicates that the pension obligation liability has increased due to differences between the expected and actual outcome or changes in assumption about the future. Again, let's assume people are living longer. So what's going to happen is this. We are going to debit a loss. This is a loss. This is a loss. We're going to debit a loss, but this loss goes into OCI, other comprehensive income, and we credit the liability, pension liability. So what does that mean? It means we reduced equity and we increased the liability. But the point I'm trying to make here is these two entries, no effect on income statement. Now what's going to happen? Let's assume we're going to amortize this $50,000 over 5-year period. So every year we will debit pension expense. I said over 5 years, so I'm going to debit $10,000. This is where it goes to the income statement, and I'm going to credit OCI, actuarial losses, $10,000. So I will knock out $10,000 out of this. So every year I will knock out $10,000 out of this, and in this year it hit the income statement. $10,000 hit the income statement. So this is what we do. We park this loss in OCI because we don't want it to go to the income statement. Then eventually we'll amortize it. I hope you got the basic idea. Now I'm not trying to teach you pension. The good thing, pension is not now on, as I'm doing this recording, it's not on the CPA exam. If it is, it's part of my intermediate accounting courses. If it is, you can view it if you're interested. I'm just showing you the purpose of OCI. So let's go back here. So what I just did, I just explained to you that pension adjustments All what you need to know is pension adjustments are part of OCI. The reason I went in steps to kind of explain exactly what does it mean from a journal entry perspective. So you carry this loss, you keep it on the balance sheet, eventually you release it to the income statement. Unrealized gain and losses, simply put, the same idea. There are certain securities, certain type of unrealized gains and losses associated with investments in debt securities and hedging activities are recorded in OCI until the involved securities are sold and the related cash flow are realized. So when you have debt investments, you invested in debt, like you have unrealized holding gains and losses from available for sale securities, debt investments. So you bought a bond, that bond went up in value or that bond went down in value, and you did not sell it yet. So you either have a gain or a loss. What do you do with that gain or a loss? Since it's available for sale, you have to report it at market adjustment. You book that gain or loss in OCI. I'm going to show you an example. But unrealized holding gain or loss is one example. Unrealized holding gain or loss resulting from the transfer of debt securities from held to maturity to available for sale securities. Sometimes you move an asset, a debt investments from held to maturities to available for sale. You have to book a gain or a loss. You book it in OCI. Basically, those are two the same. Adjustment to fair value of available for sale debt securities that have previously been marked down due to impairment. Same thing. You are adjusting available for sale debt securities. Basically, all those three deals with available for sale debt securities. We could also have gain and losses on derivative instrument designated and qualifying as cash flow hedge. Later on, you would worry or you would learn about derivative instruments that qualify as cash flow hedges. When you have a derivatives that's classified as cash flow, again, you're going to have gain or a loss, and that gain or a loss goes to the OCI first before that cash flow hedge is realized. Yes, show me an example. How about that? Example. Suppose a company holds available for sale debt securities that have increased in value by $20,000 and decreased by $5,000 during the accounting period. So here we go. We're going to just to show you both a gain and a loss. So you net them out usually, but I'm going to show you if you have a gain, what would happen. If you have a loss, what would happen. In the real, you don't book the two entries, but let's assume you have two different securities, you would book it. Now, you're going to first, for the increased in value, you're going to credit OCI unrealized gain on available for sale. So you have an unrealized gain that's booked in OCI. So you increased your equity, and you increased your available for sale securities assets. So both of those are balance sheet accounts. So the increase in value did not hit the income statement. Same thing when you have a loss. You reduce the asset and you debit OCI, which is in equity account. You debit unrealized loss on available for sale securities and you credit available for sale securities to reduce them. So I just showed you a gain or a loss. Same concept as in the pension. Same concept. So when do we get rid of this OCI? When we actually sell the securities. I will show you shortly the reclassification. And during the reclassification, we take them out of OCI. They hit the income statement. Just hold for a few more slides. So what I just did, I just showed you the second item of OCI, unrealized gain and loss. I went even further, talked about cash flow, but basically you need to know that unrealized gain and loss on available for sale goes into OCI. Guess what? I'm going to show you two more. Number 3, I'm going to go very briefly. You guys got the basic idea. And number 4, I will spend a little bit more time. Foreign currency related activities. So when you have a foreign currency, an operation overseas, a subsidiary, and they report their number in a foreign currency. Eventually, you have to translate their financial statement into, for example, the US dollar if you're a US company. Because of those translation, you might have a gain or you might have a loss. And you guessed it. Where do we book the gain or a loss? In OCI. Same exact concept. Now, I'm not going to show you a journal entry because I don't want to confuse you. But you guys get the point. Also, when a company hedges its exposure to net asset of a foreign operation, the gain or loss from such hedges are aligned with the translation adjustment. So if you bought any hedges against those foreign operation, again, gains and losses goes into other comprehensive income. Also, if you have any long-term intercompany transaction with a foreign operation, for transaction considered to be long-term, the related foreign currency transaction are also included in other comprehensive income. Simply put, if you have foreign operation and you are making currency translation, not transaction, those translation adjustments goes into effect OCI. Also, if you have any liabilities reported at fair value. What is a fair value? When the fair value option is elected, it means you are reporting your debt on fair value. So when you have a debt, you have the option of reporting the debt at book value or fair value. When you report it at fair value, it means if it went up in value, you have to write it up. You have a gain. When it went down, you have a loss. Guess what? If you choose the fair value, because that's an option, then you have to report the gain or the loss in OCI. When the fair value option is elected for liabilities, any changes attributed to instrument-specific risk. Why do we specify instrument-specific risk? Because if it's attributed to something else, like market condition, it's not reported here. It has to be related to instrument-specific risk. It means the liability itself, something happened to your liability. For example, S&P 500 downgraded you. No, S&P, the rating agency, downgraded your debt. Those are recorded in OCI rather than income statement. So what's fair value? This is the accounting choice that allows the company to report financial liabilities, simply put, debt at their fair value rather than historical cost. Fair value is the price that would be received to sell an asset or pay to a transfer or liability in an orderly transaction between market participant at the measurement date. So simply put, if you can find a fair value for your debt might go up or down, then guess what? You would report that up or down in OCI. But it has to be instrument-specific credit risk. This refers to the risk that the financial condition of the issuer of that company will deteriorate, not the market. Your debt, for one reason or another, you're not doing good, your cash flow is going down, and one of the rating agencies downgraded your debt loses value, then that loss is reported in OCI, specifically affecting the value of a particular financial instrument rather than the market overall. So this decrease is due to your specific risk. This form is risk is directly linked to the issuer perceived ability to meet its debt obligation. Best to look at an example. Suppose ABC Corporation has a bond liability initially issued at $1 million. During the current financial year, the fair value of this liability decreased to $950 due to an increase in ABC's own credit risk. So because now the company is riskier, the value of the debt went down. Well, it has to do with your company. Okay, the market perceived higher risk of default by ABC company, leading to a decrease in the bond market price. Now, what does that mean? It means your liability went down in value, you reduce your liability, and believe it or not, you book a gain, which is kind of unusual in a sense that as you deteriorate, as your market condition deteriorate, you are booking a gain. But notice the gain goes into OCI. The gains go into OCI. So that's another place where you book things in OCI. So let's review real quick what goes into OCI, just to kind of so this make more sense, or starting to form the big picture. Again, we said we have net income, then we have plus or minus OCI. Let's just say plus. Then what we do, here are the OCI items: pension adjustments, unrealized gain or loss, foreign currency related issues, and liability specific credit risk. Now, once we go through net income plus OCI will give us CI, comprehensive income. So comprehensive income is net income plus those items. What are those items? Those are gains and losses that are unrealized, and we don't want them to hit the income statement as of yet. Therefore, we park them into OCI until later. When's later? Well, we're going to see what happened to them later, but this is the idea. Now, the next thing I want you to know is this. We are going to close OCI, other comprehensive income items, to AOCI. And I showed you where AOCI ends up to be. AOCI is part of equity. Remember, that's the first thing I show you. So at the conclusion of each accounting period, all elements of comprehensive income are transferred to specific accounts within the balance sheet. Net income, remember, is close to retained earning, while other comprehensive income is transferred to AOCI. So this process ensures that the financial effect of the period activities are currently reflected in the company's equity. So everything ends up in equity. All income ends up in equity. All expenses ends up in equity. All OCI ends up in equity. So let's go ahead and close those to equity. So here's what's going to happen. Do you guys remember we had $20,000 gain on available for sale securities? let's go back and show you this here. So what I'm going to do now, I'm going to now transfer. Remember this gain here. You remember this gain? We said we have a $50,000 gain, OCI unrealized gain. This gain will have to be close to AOCI. So it goes from OCI to AOCI. So let me show you the journal entry. So I'm going to reduce OCI to remove it, and increase OCI. So equity goes down, equity goes up. It's close to AOCI. Same thing with the 5,000. We had a loss. I'm going to credit the loss to reduce the loss, and I'm going to credit the loss, and I'm going to reduce accumulated AOCI. Equity went down, equity went up because I closed the loss, equity went up because I'm reducing my losses. Same thing with the adjustment for the gain on credit risk adjustment. What we did is we had a gain, so we have to debit the gain to remove the gain. So equity went down, and we increase accumulated OCI, equity went up. What we did is we closing OCI into AOCI. So what is AOCI? AOCI is a subsection of shareholders' equity that captures the changes in equity from certain transaction and other event and circumstances that are not included in net income, which are OCI. So AOCI basically take all the OCI and park them together in accumulated other comprehensive income, just like retained earning takes net income every year and keeps it there. Essentially, it's a running total of the net changes in fair value of certain assets and liabilities that are recorded directly in equity rather than affecting the income statement immediately. Again, similar to retained earning, AOCI is adjusted each year for the addition or reduction due to OCI items of the current period. And AOCI will go up and down every year depending on whether we have additional gains or we have additional losses. We'll make the proper adjustment. So the balance in AOCI is carried forward each period continuously. It's a balance sheet account, accumulating the effect of OCI item until they are realized and reclassified to the income statement. And remember what I told you, we're going to revisit AOCI, and this is AOCI. So this is where all the OCIs end up to be. AOCI, they're eventually close to AOCI. AOCI is part of net income. And what's AOCI? Items that we changes, gains and losses, we don't want it to hit the income statement. Now, we're going to have to learn about reclassification adjustment. What's a reclassification adjustment? Those are adjustments that are used to transfer specific item from AOCI to income statement. So eventually, what's going to happen, some of these items will be released. Eventually, they have to be released to the income statement. They cannot be there forever. Once they are realized, they are released. So the transfer occurs when the realized results or impact of those items to be reported as part of net income due to the realization of the underlying transaction or event associated with those items. You remember when I did the pension adjustments, I released it eventually from OCI, but before you technically release it from AOCI because OCI, so simply put, let me show you an example of a transfer. And I'm going to start with the first example, the liability. Hopefully I did not erase the second transaction. So what happened here, I skipped a step. So before it gets released to the income statement, what's going to happen? I skipped the step where first here what's going to happen. Let me erase everything. So first what we do, this is OCI, right? Then this OCI first, it goes into AOCI. So what's going to happen is we're going to debit AOCI losses. I'm going to call it losses from pension, basically this. And I'm going to credit OCI. This is 50,000 and 50,000. I'm going to credit OCI actuarial losses. So what I did is I transferred, I credited this account. So this account is transferred to AOCI losses pension. Now, then once it's released, I'm going to debit pension expenses. And I said I'm going to release them 10,000 at a time, and I'm going to credit AOCI this AOCI, starting to release this AOCI. I skipped this AOCI step because I don't want to confuse you earlier, but this is technically how it goes, because OCI first goes into AOCI. Well, my entry would be correct if you did this adjustment before the year end, before you transfer the OCI into the AOCI, but just to kind of show you the example how the reclassification occur. So for instance, if an available for sale securities is sold, the unrealized gain and losses previously accumulated in AOCI are reclassified out of AOCI and into the income statement, reflecting the realization of these gains. Let's take a look at an example. Suppose that the available for sale securities previously reported at an unrealized gain of $20,000 are sold. So now we're going to sell them. Remember, we have $20,000 gain in AOCI. The first thing we have to do is remove the gain to remove the unrealized gain from the AOCI. Why? Because now it's realized. So we debit AOCI, unrealized gain, so basically to remove it from AOCI, and we credit gain on sale of available for sale securities to realize this gain. Then we record the transaction, assuming we sold it for $120, debit cash, credit available for sale securities, and credit the gain, and this is the gain that hit the income statement. Format of comprehensive income. Comprehensive income can be presented in two distinct formats under US GAAP. A single-step approach. This approach consolidates the presentation of net income and comprehensive income into one continuous statement. I will show you one. It first detailed net income, then lists each item of the other comprehensive income individually. These items are then summed to arrive to the total comprehensive income, which is displayed at the bottom of the statement. This is the single. The two-statement approach. Comprehensive income is presented across two separate but consecutive statements. First, we would take a look at the traditional income statement. We would end it up with net income. Then we show comprehensive income separately, starting with net income. The best way is to do what? Show you each one. So this is the one statement approach. We have net income. This is the income statement. Then we keep going. Other comprehensive income, unrealized gain, unrealized losses. Usually you net them out. Usually they are reported net of tax. We'll talk about that in the next session. Foreign currency translation gain, pension adjustments. So basically this is what we did. One statement starting with net income all the way down to comprehensive income. Because comprehensive income, CI equal to NI plus OCI equal to CI. Or what we can do is we can show an income statement separately. This is the two-step approach, just simply the income statement. Then after the income statement, we will have statement of comprehensive income starting with net income. Then we have those listed separately. Two separate statements. Now what I skipped over is we report these figures net of taxes. I don't want to keep this recording any longer. That's why I'm going to skip net of taxes, work it in the next recording, plus other items. I just wanted to give you strong basics. But before we end up, I'm going to look at a multiple choice question from farhatlectures.com. Under US GAAP, changes in fair value of liability due to the entity's own credit risk when fair value option is elected should be reported where? In net income, income statement, ignore unless they result in a loss, recorded in other comprehensive income, applied directly to retained earnings. So where do we report this? Well, you need to know this is one of the items of OCI. It's recorded in OCI. It's not recorded in the income statement. It's not ignored, whether it's a gain or a loss, and it's not applied directly to retained earnings, because if it's recorded in the income statement, if A is correct, D is correct, because income statement eventually ends up in retained earnings. So the answer is C. What should you do now? Really, you want to go to Farhat Lectures and look at additional MCQs that's going to help you understand comprehensive income, other comprehensive income, accumulated other comprehensive income. We're not done yet. We are not done yet. We still have quite a few things to learn about other comprehensive income, specifically the reporting of net of tax effect, that's important, just like with discontinued operation. Invest in yourself. Study hard, whether you are a CPA candidate, accounting student, or studying for some other professional certification. Farhat Lectures is always here to help, and stay safe.